Okay, in this session, you're going to learn how do you use moving average to profit as a trader. Now, to put it simply, what are moving averages? Basically, they are calculated by averaging the closing price of X number of periods. Let's say you are using a 20 simple moving average. Okay, and how is that 20 SMA line calculated? It's just by taking the average of the closing price of the past 20 candles divided by 20, and then you get the moving average of 20 SMA. Okay, to put it simply. So you realize that 100 SMA looks very different from a 200 SMA, and also looks very different from a 20 SMA or a 5 SMA or EMA. Okay, so how is it different? The lower the value, the faster it will respond to the changes in price action. To put it simply, the lower the value of the moving average, the more likely it's going to stick towards the candlestick, meaning that it will follow the candlestick more as compared to the higher moving average values. And also, the lower the moving average value, you realize that it is more volatile as compared to the moving average with a higher value. So let's say if you look at a 200 SMA, it looks more smooth as compared to, let's say, a 5 SMA. So one thing about moving average is that the slope can help you determine the potential direction of the price action. Later I'm going to share with you what does this really mean. What does the slope has to do with where the price is going. And the other function about moving average is that it allows you to trade along with the trend. Or in other words, it prevents you from trading against the trend. Now, if you study very successful traders, they will always talk about this one thing. Never ever trade against the trend. And how do you prevent yourself from trading against the trend? How do you prevent yourself from selling when you are in the bullish market? How do you prevent yourself from buying in the bearish market? Okay, later I'm going to share with you how to determine that. So there are two main types of moving averages. The first type that's very commonly used is the simple moving average. Now the simple moving average, it tends to smooth out all the market fluctuations and volatility. In other words, it puts your focus onto the overall trend of the market rather than being distracted by the temporary current volatility of the candlesticks. Okay, and the SMA tend to have a very slow response to the changes in the price action. Now, of course, it allows you to determine the overall big picture of the trend. That's what you use it for. So realize that we don't use simple moving average to enter. We don't use them for entry and exit. We just use it to look at the big picture. Okay, are we buying in the bullish market? If yes, then we will continue buying. Are we selling in the bearish market? If yes, then we'll continue selling. So let me give you an example. So you can see these three lines that are drawn right here. The first line that you see over here, the red line. Okay, you realize that it tends to stick and follow the candlestick a lot more as compared to the other lines. Okay, so this one is the 20 SMA. The black line is the 50 SMA. The green line is the 100 SMA. And you realize that, again, the 50 SMA, it tends to be less smooth or more volatile as compared to the 100 SMA. And of course, when you look at the 20 SMA, it is a lot more volatile than the 50 SMA, than the 100 SMA. And of course, these three different moving averages would have different functions. Now here's one tip. The larger moving averages, we use them to help us determine whether we are trading along with the trend or whether we are trading against the trend. That's it. We don't use it for enter, exit, trading reversals, none of that. But the smaller SMAs, they have a whole entirely different function, okay, which I'm going to talk about later. So the second type of moving average is the exponential moving average. Now a lot of people call it the EMA. it actually stands for exponential moving average. And it responds to the changes in price faster than the SMA. So the EMA allows you to take your trades earlier. Okay, you might get a clue right here. What's the function already? Meaning that it will sort of give you the signal to enter or to exit. Okay, I'm going to teach you more on this when we go to the main systems. Okay, although it allows you to enter or exit, the downside is that it will provide more false signals or false breakouts. And of course, when it comes to trading breakouts, there are a lot of false breakouts. And in order for you to prevent yourself from getting into false breakouts, we use exponential moving averages. Because a lot of people, the way they trade breakouts is that they're going to see a candlestick breakout. And then they're just going to rely on that, and then they go into it, and then they get killed into a false breakout. But when you add an EMA into that, it is going to give you sort of like a confirmation signal that this is a real breakout to get into. But of course, just like any other system, there's no such thing as a 100% win rate system. Okay, just bear in mind that. Breakout strategy I'm going to share with you in the next few lectures. But right now I'm going to share with you more on how the EMA works on a chart. Okay, so you can see on this chart, the 5 EMA, it tends to follow the candlesticks a lot. Or in other words, the candlestick tend to follow the 5 EMA a lot. So what does this mean for you? Aside from using 5 EMA to trade breakouts, you want to make sure that you don't go into it trading a reversal. What do I mean by that? Another function of 5 EMA is that it will prevent you from getting into trades where it might just reverse. Okay, so for example, because you already know that the candlestick tends to attach to the 5 EMA a lot. You can see right here. Okay, see 5 EMA as a magnet for the candlestick. So you can see that this candlestick right here is detached from 5 EMA for a while. Then eventually it has to come back down to stick to the 5 EMA. Same for this one. It's detached from 5 EMA. It has to come down slightly to go back to 5 EMA. So this is when the candlesticks follow the 5 EMA. But sometimes you might also see the 5 EMA following the candlestick. Because a lot of people ask, Karen, can I make a sell over here? Because I know it's going to come back down and attach back to 5 EMA. No, you can't. Because for example, for this one, right now the 5 EMA follows the candlestick. So this candlestick, although it's detached from 5 EMA, if you make a buy here, you might have died because the price continued to go downwards. Alright, the price continued to go downwards. Instead of going back up here and then attach back to 5 EMA. So then what's the function of this main theory right here? Basically, if you are to make a buy over here, you know that you shouldn't put your stop loss right here. Or you shouldn't have entered here to begin with. You might want to wait for it to retrace back to 5 EMA before you make a buy. Or the second thing is that you don't want to put your stop loss here because you know that the price will eventually has to come down and attach back to 5 EMA. Right? So in other words, it prevents you from trading mini small reversals. Okay, that's the other function of 5 EMA other than helping you to trade breakouts. The breakout part I'm going to share with you more later on. This is one of the functions of 5 EMA.